Hey everyone, and thanks for jumping back into the cryptoverse. This is a premium video. I hope you guys enjoy it. It's going to be a long one. We're going to talk about a lot of things. The markets are moving, but again, it's business as usual. We were expecting this, we're prepared for it. We have our plan in place, and we're going to stick to it. And this is ultimately going to, I think, to turn out very well. So let's go ahead and jump in. This is one of those things that we've spoken about before. And by the way, before we start, I want to go ahead and say, so we're first going to start on modern portfolio theory for BELA, Bitcoin, Ethereum, Link, and ADA. The reason is because so many people have requested this because I did it on some older coins, and since these are the four main coins that I follow, it seems natural that I would develop the efficient frontier for these four coins in terms of maximizing your risk-adjusted returns based on historical data. There are some challenges with it because we don't have a lot of data, but we're going to start with that. We're going to start with modern portfolio theory. If you haven't seen that, if you haven't learned about it from prior videos or reports, I would encourage you to go back and watch those. There's at least 2 premium videos and those 2 reports to accompany modern portfolio theory. So we're going to start with modern portfolio theory. Then we're going to jump into just looking at the markets, trying to get an idea of where things are. Then we're going to look at the risk dashboard. And then, I'll talk about what I'm doing, somewhat in that order. So let's go ahead and jump in. I mean, you guys can also feel free to leave comments below the video, but I would encourage you, if you haven't, there are a lot of you still that have not joined the Premium Alerts Telegram channel. So if you want to join it, just send me a message on Telegram at BJCOWEN and just send me the email address you used to sign up and I'll get you added there. So let's go ahead and jump in. So if you're not familiar with this, this is your expected return versus your volatility color-coded by the Sharpe ratio. Now, the Sharpe ratio it's your risk-adjusted returns, okay? So that means that you're accounting for some level of risk in the coins that you get. If a lot of the questions I get are, if you think Ethereum is going to outperform Bitcoin by a few X, why not just go all in on Ethereum? And of course, the answer is risk-adjusted returns. You need to improve your covariance matrix when calculating your returns, because otherwise, if you don't, and one asset that you're holding, let's say you choose Ethereum, and then for whatever reason that asset doesn't perform well during this market cycle, I know we all think it will, but again, there's always that chance. So you have to account for for the volatility of the different assets, and then use that to figure out what your your expected return or your risk-adjusted returns would be. So that's what the Sharpe ratio is. So we're looking at the expected return. This is based on historical data, and we're taking it from 2018. We can't take it, we can't take Bitcoin and Ethereum data from before that, or we can't take Bitcoin and Ethereum data from say 2015 or Bitcoin data from 2011. Because it would completely mess up the covariance matrix if you're comparing different time intervals. So you have to use the same time intervals to really get a realistic result, or a useful result, I should say. I mean, all models are wrong, but some are useful. And if you put garbage into the model, then you're going to get garbage out. So this is since 2018, and if you look at this here, starting at your lowest volatility level, maybe around 76% or 77%, wherever that turns out to be, and then going up this curve, this is what's known as your efficient frontier. So for a given volatility or risk level, there exists a single portfolio at that risk level based on historical volatility that should maximize your expected return. So 0.4 would mean a 40% return. So you could say, okay, well, this portfolio here should give me an expected return of 40% annually and a volatility level of 105%. So what this means is that within one standard deviation, given data from 2018, your expected return would be 40% plus or minus 105%, meaning it could go negative, negative like 65%, up to 100 and 145%. So within one standard deviation, which means a 68% probability that your expected return within 1 year would land between that window. I get that that window is large, but considering how brutal the bear market was and how significant the volatility has been, it makes sense that you can't predict it any clearer than that. And again, these are not projected returns. It's not what Ben thinks. This is just based on expected returns. I'm sort of making this video or doing this so that in a future video we'll talk about projected returns for BELA, Bitcoin, Ethereum, Link, and ADA, and then use that to show, okay, well, what would the optimal portfolio be? But this one was kind of like a primer to, looking at expected returns based on historical returns. So given various volatility levels or risk levels, you can see the different portfolios. So for say an 80%, so for among the lowest volatility, based on data since 2018, you would want 82% Bitcoin and 14% Link with small amounts of Ethereum and ADA. If you're willing to push that, push your risk to a higher level, you can see that, for a risk of say 110%, a volatility of 110%, you're only going to be holding 30% Bitcoin and 66% Link, and small amounts of ETH and ADA. And the reason why it's so small for these two is because since 2018, these two have performed very poorly. And we've said that ADA certainly had no business being, valued at $1.30 back in 2018, but it was, and then it experienced the brunt of the bear market. And because of that, of course, it's not going to appear as an asset that you would want to hold if you're taking into account that bear market. And you can see that with this, it only includes say 0.8% ADA, because it does help out, I guess, with the covariance matrix in terms of reducing the correlation between it and other coins. Now, if you look at say since 2019, you can see it tells a slightly similar, a similar result. 65% Bitcoin at the lowest volatility or near the low at 80%, and 31% Link with small amounts of ETH and ADA. And then similarly, you can see that at the higher volatility level, you're wanting say 11% Bitcoin, 77% Link, and 11% ADA. And this is based on data since 2019. Funny enough, if you maximize the Sharpe ratio for any type of volatility, so or you say the volatility can vary, I just want to maximize the Sharpe ratio. I want the Sharpe ratio to be as high as it can possibly be, and I don't care what the volatility is. So it would correspond to way up here at around 1.75. Well, I did run the linear or the least square solver on this to just identically solve for the portfolio with the best risk-adjusted returns since 2018 and 2019, and it turns out it's 100% Chainlink. And the reason is because Chainlink outperformed Bitcoin by 5 to 10x during the bear market, and thus it has been by far the best investment. And so far, it has been so good based on 2018 and 2019 data, or up till present day. So it's starting in 2018 and going up to present day. It's been so good that it was better to just have 100% Link than to have any Bitcoin or Ethereum or ADA, because even including those, while it would improve maybe your covariance matrix to some degree, the returns that you saw with Link were just too high to merit holding the other coins. Now, this is one of the shortcomings of looking at data from only a few years, because ADA and Link have not experienced a full bull market, and because these haven't experienced a full bull market, we're not including data from Bitcoin or Ethereum that have experienced a full bull market. So again, it's not a fair comparison. Certainly, if you had included data, if we could go back and include more data for Bitcoin and Ethereum, then you would probably have much higher positions of Bitcoin and Ethereum than Link and ADA. But I'd have to check that. I don't actually know. But if you take a look at older videos where we look at say Bitcoin, Ethereum, and Monero, it turns out it's about 50-something% Bitcoin, 20 to 30%, I think 30% something Ethereum, and 17% Monero. And then if you were to do it with say Bitcoin, Ethereum, XRP, and Litecoin, it's 60% Bitcoin, 40% Ethereum, and 0% Litecoin, and 0% XRP. I think it maybe was 0.4% XRP, but it was really close to 0. So let's now look at 2020. Well, 2020 tells a different story. So here, ADA has been the one that's been shining, and if we're only including data since 2020, you can see that having a significant portion of ADA does maximize your Sharpe ratio for given levels of volatility, seeing as high as say 73% at a volatility of 110%. And actually solving for the best portfolio with the best Sharpe ratio, as in 2020, it'd be 100% ADA, which again is a shortcoming of only having a limited amount of data. We're going to quickly go through this. I mean, I imagine this part of the video is slightly boring to at least a decent portion of you, especially given how crazy the markets are right now. But just for completeness, I'm just going to quickly show these for the Sortino ratios. The Sortino ratios only punish negative volatility and not positive volatility. So you don't want to necessarily punish the asset for having positive volatility. If it's going up, that's great. You don't want to necessarily punish it in terms of calculating your risk-adjusted returns, which is what the Sharpe ratio does. The Sortino ratio only punishes negative volatility, but you can see that it basically gives you the same results. For data since 2018 and 2019, you're looking at basically holding Bitcoin and Link, and then for 2020, and I guess I don't have all of them labeled properly in the dates, but for 2020, it's primarily ADA that you would want to hold and Link to maximize your gains at higher volatility levels. So this is just an exercise. I wanted to put this thought exercise out there because I've gotten so many requests about running this for BELA, Bitcoin, Ethereum, Link, and ADA, and I just want to show it for completeness, not to say that I think it's useful, but just for completeness so that you guys have it and you know why it's taken me so long to really talk about it. It's just because I don't really think it's that useful. I think what will be useful will be looking at the volatility levels, the historical volatility levels, putting in projected returns over the market cycle based on our regression analysis that we've looked at. So maybe putting in like $120,000 Bitcoin, maybe like an $8,000, $9,000 Ethereum, and then going down the list and saying, okay, well, where could these assets actually realistically get to? And let's actually base it on some data science, not just throw a number in the air and say, this is what we're going to use. So that'll be a future video. And then we'll try to identify, more precisely, not that it's financial advice, but what would be the portfolio that would maximize your risk-adjusted returns during the market cycle that we're in. Let's go ahead and jump into the markets here. So, there's a lot of stuff going on, and we have a lot to get through. So, the first thing I want to talk about is Bitcoin. And let me actually check the current price, because when I started making this video, the price was I think around 10,100 or so. But I'm guessing it may have gone up if Ethereum continued to go up. It looks like it's around 10,180 at the time that I'm recording this video, but actually no, it's now 10,300. So we're getting close to that $10,500 point. Note that a lot of people are thinking of 10.5 as a resistance level, mainly because if you look at 10.5, that was where our last high was, our last local top. So people are going to be looking to this level as a potential resistance point. Okay, and if that were to occur, then you could see the prices come back down to 10K, and then maybe we'll hold 10K as support for a change rather than holding it as resistance. But look to 10.5 as a potential huge breakout area. This could be where if we break 10.5, Bitcoin could quickly climb to 11K, 12K, 13K, and even 14K. I know it sounds crazy, but remember, this exact scenario played out last summer, where Bitcoin went from 3,100 to 14K, and it went to 14K during the summertime. And this was, it was mania. Everyone said it's just going to 100K right now. Stay level-headed. Let's stay focused on the plan, and let's just stick to it. So, look to 10.5 as an area of resistance. Again, like 6K was supposed to be resistance on the way up back in 2019. Bitcoin just sliced through it like butter. So I mean, while 10.5 is this theoretical resistance area, don't be surprised at the same time if you just see Bitcoin shoot through it. Now you can see I made this video the other day on looking at this long-term trend line. You can see that we've completely broken out of that, and the issue, right, is you can easily redraw this trend line, based on whatever narrative you want to tell. And I even said, I'm sure some people will be saying it's not broken until we get up to around that 11,000 10.5 mark. But if you're just drawing it from, say, candles, we've clearly broken through it. And as we've shown before, there's always a point where you do break through it. And it just becomes like, it just acts as a huge resistance level until you break through it. And then historically speaking, that is when the bull market has started. Now, if we put on that 20-week moving average, let's put on, actually, I guess I need to change this to weekly. So if we put on, say, the 20-week moving average, then you can see that, we're still relatively healthy. We're still pretty high above it. And, the 20-week is currently at around $8,300. And until we really test it, it could be a while. And in the past, it took testing it to really confirm the bull market. So I would say we still need to test it. There's always a chance we drop back down at some point and kick the can down the road. But for the time being, we're still doing quite well. And even over here in 2019, we were above the 20-week for a long time. But then when we finally tested it in September, we fell through. So this is ultimately what we want to see, because in the past, the 20-week moving average is what we needed to hold as support for the bull market to really get in gear. And also, of course, having the golden cross helps, which obviously is going to happen if you're staying above the 20-week moving average. So, Bitcoin is doing quite well, and this is personally why I have a stop loss set on Ethereum for, according to 1/15 of my position, to transition it back to Bitcoin if Bitcoin, say, makes a move to 14K. Now, if we look at Ethereum, we've been talking, right, about this moving average for a long time, that 20-month moving average, and saying, if you look at these wicks, each one of them has gone up to that 20-month moving average. And if we can get a candle above this, we're just going to shoot up. And the thing is, I made a video not too long ago talking about this, and that this is likely our next accumulation region between around 0.03 and 0.04. This is our next accumulation region. But with that said, this could be our next accumulation region, and you maybe see something like that. There is a chance, a non-negligible chance, that it shoots up, to 0.5 or higher, and then comes back down, and then this is the accumulation region. Now, let me tell you a scenario where this could happen. If Ethereum goes to, say, 750, like the video we showed the other day, where we looked at, say, historical performance of Ethereum during the bull market, noting that it was overvalued by certain percentages during the last market cycle, and then projecting those out with diminishing returns to the next cycle. It suggests that Ethereum could reach 750 within the next 1 to 2 years or so. It could happen next month, could happen next year. But it does suggest there's a good chance that Ethereum will get to 750 at some point, during the market cycle, before, say, the speculative bubble, the more intense speculative bubble later on in the market cycle, because we're still relatively early. It's only 2020. The idea is that this is going to take several years, 2023 probably, before we really peak. It's going to take a long time to continue to push Bitcoin up. And it's going to be a long journey, but we're going to go through it together. And we're going to be there every step of the way. So the idea is that, well, if Ethereum, given how DeFi, decentralized finance has just completely taken crypto by storm, and there's been so many, like Uniswap moon missions, it seemed only natural that Ethereum would make a move. And this is exactly why last week my profits from Link went directly into Ethereum. Because, we said Link has made a move. The risk, right, and we're just talking about these different assets, the risk on Link at the time went to 0.82. And what did we say? At this level, at a risk level of 0.82, we historically are near our top. And let's wait for the risk to come back down to, say, 0.55 to 0.65, which is historically our accumulation region for Link, and this is with respect to Bitcoin, to potentially convert back. So the idea was you ride Chainlink, right, when the market isn't moving, because it performs really well, right, when the market's not moving. It does really well on its own. We've shown that several times in several Chainlink videos. You ride that move. You then convert that. We converted that to Ethereum because Ethereum was just primed for a breakout. Now Ethereum's moving. And during that same time, Link went down. So not only did you know if you followed that trade, not only did you see the move that Link saw, but you got a portion of those profits out, 1/5 approximately. And then if you followed the strategy I did, and then move that into Ethereum, and then now Ethereum's moving, and what is Link doing? Well, it's not doing much of anything. In fact, the price is dropping, and the reason is because it's uncorrelated to Bitcoin. Because it's uncorrelated to Bitcoin, it makes it a good coin to hold in your portfolio because it reduces your overall volatility. And by reducing your volatility, it improves your covariance matrix. And this is why Link is among the best coins in crypto to have in your portfolio, like after you already have Bitcoin and Ethereum. So Bitcoin and Ethereum first. Link is one that vastly improves your risk-adjusted returns. So you can see this is dropping. This ratio was 0.82 just like 1 or 2 days ago, 0.82. And now it's 0.73. So it's dropping. What did we say? We said, well, if it gets to between 0.55 and 0.65 against Bitcoin, it might be worth accumulating more. So here's one potential way that this could go. We rode Link up to its next, all-time high, around $8. I took the profits at 805, as noted in the alerts channel. So you took the profits at 805, converted to Ethereum. Ethereum was 235 or so. I don't remember exactly what it was. It was around 235 at the time. Now Ethereum is 326. So you got out of Link, if you copied me, at 805. It's gone down to 725. You got in Ethereum at 235. It's now at 326. Now the idea, right, is, okay, well, the Ethereum Bitcoin risk is getting high. Now it's 0.56. And not that long ago, it was much lower. And so now, the point, right, is to say, well, the Bitcoin risk is getting, or the Ethereum Bitcoin risk is getting kind of high. So maybe it's time to potentially set a stop loss, right? I mean, say, okay, well, this is getting high. At some point, Bitcoin could really start moving, and it could leave Ethereum behind. And this is what always happens, right? Altcoin, you'll see coins like this move, then everyone moves out of Bitcoin because they're chasing these other coins, and then at some point, all the money flows back into Bitcoin, and then it's like these other coins are just sitting still while Bitcoin makes its move. Okay, you don't want to miss this. This is why it has been, and it always will be the largest percentage of my portfolio is Bitcoin. So the idea is that we went from Link to Ethereum. Now Ethereum's up significantly, right? Since last week. Now that Ethereum's up, the Bitcoin risk on Ethereum is quite high. So what did I do? I set a stop loss. And according to the alerts channel, I set a stop loss at a ratio of 0.0295 with respect to Bitcoin a couple days ago. That was never hit. The Ethereum Bitcoin ratio continued to go up. Now it's 0.0317. So I moved the stop loss up to 0.0305. And if you go to the Ethereum risk tab, you can see that 0.0305, which 0.03 corresponds to an Ethereum Bitcoin risk of 0.55. So if you set your stop loss around this level, it ensures that you take profits of Ethereum with respect to Bitcoin within the 0.5 to 0.6 risk regime. And then because Bitcoin has not seen the same significant move yet, maybe you ride the Bitcoin move up. And where this becomes really nice, theoretically speaking, of course it doesn't have to happen, but a nice scenario that could theoretically play out would be that if Bitcoin moves, so let's hope that maybe they don't go down. Maybe the stop loss at 0.0305 gets triggered because Bitcoin goes to like 12K or something. If that happens, and then say Ethereum either maybe sits still, doesn't really do a whole lot, then you've taken those profits from Ethereum, you've put them into Bitcoin. And where this could be timely is if then you ride Bitcoin up, and then at the same time, the Link Bitcoin risk is dropping back down to the 0.5 to 0.55 to 0.65 level, then you've come full circle. You started with Link, you converted it to Ethereum at a timely point. The Ethereum moved, Link went down. Then at some point you set a stop loss to go from Ethereum to Bitcoin. Then Bitcoin went up. When Bitcoin went up, the Link Bitcoin risk went down, and then therefore you capitalized on every single move. So this is the idea behind the risk metric. It's not based on emotions. just based on the numbers, and you stick to the numbers and you hope it works out. With that said, there's something else we need to talk about. We need to talk about taxes. And we're not going to do a full video on taxes right now. I will probably do a future video on short-term capital gains and long-term capital gains. We'll go through various calculations so that you can get a better idea of what you would need to see in terms of a return to make short-term capital gains worth it. Short-term capital gains can be quite expensive, it depends on the tax bracket, obviously, but they can be significantly more than long-term capital gains. And if you live in the United States, long-term capital gains mean you have to hold for a year. And if you do, then your tax rate is significantly less than short-term. Where does this become important? Well, at the end of a speculative bubble, if Bitcoin is 100K, and let's say you bought some at 30K 6 months before, you're not necessarily going to want to sit on that for another 6 months so that you can avoid short-term capital gains, because there are such things as good problems to have. I'd rather pay short-term capital gains on, say, a 70K profit than to pay long-term capital gains on, say, a 20% loss, or a 10% loss or something. Obviously you're not paying capital gains if it's a loss, but you get the idea. It's better when you have a bird in hand to, especially if you're up significantly, to take those profits. Now, where could you guys get, burned if you're not prepared? So if you lived through the last market cycle, then a lot of you are probably aware of this, but some people got burned really bad. And let me give you a potential scenario as to how it could play out if you're not careful. In 2017, a lot of people made a lot of money on Bitcoin, okay? You put in a lot of money at around $200, and then Bitcoin ultimately went up to $20,000, okay? So Bitcoin went up, and I still have some relics of a past video on here, but Bitcoin went up to 20K. A lot of people saw 100x. It wasn't that hard. Just buy in the accumulation range, 100x, okay? Take profits. Then you're up. You have more money than you know what to do with. Let's just say that you have, maybe 50 times more money than you've ever had before, okay? You have all this money. You consider it to be the house's money because you just made it on internet money, whatever you want to call it. I don't call it that, but this is the idea that a lot of people had. They then saw other coins taking off, like Ethereum, Cardano, Link, XRP, Litecoin, EOS, Binance Coin, XLM, all these coins, Tron, all these different coins that just started skyrocketing, right? What did they do? They just gambled it away. They put they put several $100,000 into all these coins, and what happened? They took their profits, put in the coins. The coins maybe went up in the short term. They got greedy. They kept doing it, and then they lost everything. Okay, where does this become a problem? Well, if you took profits in 2017, right? You took your Bitcoin profits in 2017. You owe the capital gains for 2017. But then a lot of people turned around and lost all that money. So then they have this issue. They have a tax burden where maybe they owe, like, the IRS $500,000, but they lost all of it, so now they can't pay it. And, there's limits. First of all, you can't, we're only talking about 2017 taxes, not 2018. So, you can't retroactively, say that, oh, well, I lost that money. You have to pay the IRS the money for the gains that you saw in 2017. So you don't want to be this person in, say, maybe 2022, 2023, where you're cashing out 30, 40x, you go gamble it away on altcoins, and then you owe the IRS a ton of money, and then you can't pay for it because, you just can't afford it. This is why I say, what have I always said? Once Bitcoin gets to its previous all-time high, a lot of coins will move. We're going to be ready for it. But then at the end of the bull run, so, when we're out in, say, maybe let's say 2023 or sometime over here, let's say, and maybe it'll be 2020, late 2022, late 2023, I don't know. Let's say that happens, and you take profits. You take your Bitcoin profits, you take your Ethereum profits, whatever profits, you put it in the bank. You put a lot of it in the bank. You don't then just go gamble it away, right? You can take a small percentage of that, and then you can go to town with it if you want. But you need to be able to cover the taxes that you're going to owe, because it's not all fun and games. It is fun and games, but it's not fun and games when the IRS comes knocking. So you need to be able to cover that. And if you can't, then you're going to have a lot of issues. So make sure you can cover the tax burden when it comes. And the main thing you can do to cover that is to just make sure you're taking out at least that amount of money to cover your taxes. What I'm going to do when Bitcoin at the end, I'm just going to take out 90% and put it in the bank. And that's just what I'm going to do. I'm going to take 90%, put it in the bank. There are a few moves that I'm planning on making at the end of the bubble where I think you can still make a lot of money. But we'll talk about that when the time comes. I don't want to overburden you with these plans now because it's several years away. And, the nature of the premium list 3 years from now is probably going to look a lot different than it is today. There's probably going to be a lot more people that have never heard these thoughts, so I'll save it for then or closer to the time. For right now, the goal is you have to be smart, in terms of forward thinking with regards to taxes, because you don't want to get stuck like the people in 2017 and 2018 who made a lot of money and then lost it all. You want to be making a lot of money. Then maybe for 1 or 2 weeks, you can speculate on a small percentage of it if you want, not financial advice. And then get out before the party's over. And likely the party's over when the 20-week breaks. We have the risk metric. I mean, the 20-week, right, is a bit of a lagging indicator because by this point, Bitcoin was already back down to, say, 10K or so, or around 9 to 10K. We have the risk metric. It'll help us identify where the peak of the Bitcoin bull market is. Likely, we have 1 or 2 weeks tops for other coins before the market's going to come crashing down. And you need to be ready. I mean, you look ahead now and we know, okay, it's not going to go up forever. Well, try telling the people in 2023 that when they're buying Bitcoin at 100K. If I'm going on YouTube and telling them that, hey, the party's almost over, they're not going to want to listen. So I hope you guys listen now. I'm coming to you now in 2020 so that you'll believe me in 2023 when I tell you, or whenever it is, the party is almost over. So we covered Bitcoin. I do want to cover one more thing with taxes. Actually, we'll do a video on this later, but I'm here talking about it. Each trade that you make now is subject to capital gains, whether it's crypto to crypto or crypto to fiat, even if it's crypto to stablecoin. So if you're making, say, a link to Ethereum trade or an Ethereum to a Bitcoin trade, you have to pay capital gains, and it might be short-term capital gains depending on how long you've been holding it. So we're going to talk about that in a future video. Personally, for me, I'm okay with this right now because I found for me it has worked out. But you can imagine that, like, say you make a trade of Ethereum at a ratio of 0.0305, and then it gets triggered, and then very quickly Ethereum turns around and goes back up, and you maybe would have just been better off holding Ethereum and getting the discounted taxes because you're paying long-term capital gains as opposed to short-term capital gains. So this is where, when we talk about the risk metric, you want to consider the idea, right, of the gray region. And the gray region, if I just pull up, say, a risk chart here, the gray region, is, just to remind you, would be it would essentially be only buying in, say, a certain zone. Let me just, maybe it was on the Ethereum risk chart that I showed it. Oh, here it is. So it could be that you're buying Bitcoin down here, and then when it gets into this region, you don't do anything, and then you wait for it to get to this higher risk level, and then you dynamically DCA your trades. By the way, this should be a 6, not a 9, because y plus 2, y plus 3, y is 6, not 9. So this is the idea. If you want to help avoid the tax situation of short-term capital gains, all you're doing is you're accumulating Bitcoin or you're accumulating Ethereum. You're not swing trading between the coins. But the risk metric can still be beneficial to you because it can help you identify which coin to be getting in that week or that month, whatever your DCA schedule is, to maximize your, or to minimize the weighted risk of your portfolio, because you want to get in for the lowest risk possible. So if you go back and say, look at the Google Sheets, right? Like for instance, this week, I certainly would not be buying Link, because the risk is through the roof. But if you're not looking to, say, swing trade, which is what I like to do a lot of times based on the risk level, if you're not looking to swing trade and you're just looking at it more like, I don't want to focus on all that. I want to cut out the noise. I want to accumulate the coins I like, develop the positions I like in 2020 and 2021, and then sit on it till 2023 and then sell. If you want to do that, that is fine. What you could do though is each week you look at the risk levels and you say, you know what? This week I see Bitcoin risk is lowest. I'm going to put the money into Bitcoin. Next week, maybe you see that the link Bitcoin risk has dropped down to 0.55 or 0.65, and you recognize, you know what, historically speaking, this has been a good time to get into link. And then that week you put it into link. And then maybe the following week, ADA has dropped back down to 0.45 or 0.4 or something. You say, okay, well, this week I'm going to put it into ADA. So this is another way you can use the risk metric without having to say swing trade between all these different assets and accumulating all these short-term capital gains that you're then going to have to pay the IRS. So it's just something to consider. By the way, now that I'm looking at it, I will be publishing gold and silver risk metrics and silver gold. So gold USD, silver USD, and silver gold risk metrics, hopefully sometime this week, just so you guys know. Also, I would like to remind you that with traditional markets, I've been buying, as I said, since March. I've been purchasing mutual funds, FZILX and FC Rocks on Fidelity. And I would probably start looking to take profits at 0.75. So we still have a ways to go. If you go over to the S&P 500 risk table, you can see that 0.75 corresponds to at least 3,400. So what I probably would do is wait till it gets above 3,400, and then potentially, look to potentially taking some profits there, because historically speaking, the risk level does not stay above 0.8 very long whenever it gets there. What else? Tesla. We actually have a Tesla video coming out relatively soon. And we said, if you hold Tesla, what did we say? 1900 is likely the local top. This is not updated, by the way. But for those who were looking at it, and we have it on I have it on TradingView. It did look like it was the top, and now Tesla's back down to 1400. Consider this as a lesson for a potential future Bitcoin, and saying that when everyone's telling you that they're putting in calls for twice the price a month from now, it's likely time to get out. Looking at the ADA Bitcoin chart, what do we see? Well, these are the same lines we've had drawn for a long time. First, we broke out of this level. We came up to the halfway point. What did we say? Bitcoin stays bullish, or if Bitcoin just stays humdrum, hopefully, we're gonna continue to see ourselves work our way up. In the short term, we have, but you can see that recently this has started dropping again. Why? Well, it's because ADA USD has dropped back down to 0.13. But also because Bitcoin is climbing. So it's kind of like, you have two things going on here. Bitcoin is going up and ADA is going down. This could be, as I said before, it could be that Bitcoin is starting to reclaim some of that market share and could make a significant move here in the next few days. I don't know. I think 10.5. Let me, before I say too much, let me check the current price. Bitcoin's still at 10.3. But yeah, if Bitcoin decides to blast through this level, then I would expect ADA Bitcoin to start dropping. Okay, because ADA, rest assured, I highly doubt ADA is going to keep pace with Bitcoin if Bitcoin's going to 14K. I highly doubt it. Now, it'll bleed likely, maybe not with respect to USD, but it very well could. Definitely with respect to Bitcoin. But if it does, then likely sometime after Bitcoin stabilizes in a certain region, then ADA might move again. So, really, as long as Bitcoin was staying still, ADA was still doing quite well. Now, starting to drop a little bit. I'm still, I'm not taking profits on ADA quite yet. I did take profits a couple weeks ago, as documented in the alerts channel, or it was like a week or two ago. I don't remember exactly when it was, but I took 1/15 of my position and I converted it to Ethereum. Ethereum's done quite well. ADA's also done well since then. But I'm happy with the conversion to Ethereum because I've been accumulating Ethereum since we broke above the 20-week moving average, as I've told many of you back in April 20th of 20 or April 20th, April 27th. I've been accumulating Ethereum quite aggressively, which has included converting some Bitcoin to it. Now I'm looking to say, okay, well, if the Ethereum Bitcoin ratio starts dropping, I want to convert some of that back to Bitcoin because maybe it's Bitcoin's time to shine. Looking at the Link Bitcoin chart, it tells the same story it's always told. Same story. I mean, I don't have the full chart here, right? But I mean, you see the general support region. If this comes back down, this is going to correspond to that 0.55 to 0.65 risk level. So if you see it come back down to this point here, and this is what I would be looking at. I still have 4/5 of my Link position, but I would potentially accumulate more if we get back down to that level. If we don't, then I'll just continue to sell if it goes up to $13. $13 for Link, right? If you go to the Link, if you look at the Link risk, so if you look at the Link risk, it's around, I don't actually have it, I guess, right here on hand, but around $13 will get us to around a 0.75 risk level or so. So I'm looking to around $13 if it doesn't come back down in the meantime. I rambled on quite a bit. I just wanted to give my thoughts on the market. You can also see here the regression line. We made a video not that long ago, right at the fair value, and said, guys, when we're at this level, it tends to be a really good time to buy. And maybe it'll go down in the short term, but if it does, it'll be relatively short-lived. Well, it said, you know what? I'm not going down, going up. And now we're getting close to the top of our regression band here. You can see the top is at 336, and Ethereum right now is trading at 324. So 324, the top of it is 336. You can see in 2020 we came right above the regression band, and then that's when we came back down. So it's possible, that we come above it and then we again retrace a little bit. And this is another reason why I do have that stop loss set on Ethereum Bitcoin. Not Ethereum USD, but Ethereum Bitcoin, because if it does start to come back down, I at least want to ensure that I take those profits back to Bitcoin, because some of my Bitcoin had been converted to Ethereum originally. I think that'll wrap it up for the video. We've talked long enough. Let me know what you guys think. I know it was a long video, but I really wanted to get my thoughts out. Leave a note in the comment section below if you have ideas. Remember, on this page, you can go to the dynamic DCA strategy page. Actually, I think I need to fix this because I think I don't actually have it edited. I don't think I have it so that you can edit it right now. I'll try to fix that soon. But the idea is that you can come in here, maybe put in however many Bitcoin you have, and then you say, you can put in, say, your projected future peak. Let's say you think it's going to be 160. And then it tells you, okay, well, based on, projected prices at different risk levels, then if you sell according to various strategies, then this is how much you would make. And it's cumulative. So it means selling at 0.4, you'd be at 73.5. Selling at 0.4 and 0.5, you'd be at 197, and so on and so forth. You'd be at 1.69 million by 0.9 risk level if you wait, and so on and so forth. And if you take the YOLO approach, which I don't recommend, which means you just wait and sell everything at the 0.9 level, you're obviously getting the most bang for your buck because you're selling it for the high risk level. This one shows if you base it on different strategies. So this is a linear. All three of these are sorry. This one's linear. So this one's selling the same percentage at each level. This one's a linear scale. This is what I do: y plus 2, y plus 3, y. This one's exponential. And then this one's the same thing, but selling at the middle of the band. So you can just play with it. You can put in, say, maybe you have 3 Bitcoin. You think the price is going to go to something ridiculous like 250,000. And then you can see, okay, well, based on these different strategies, I can see, where I might end up. And the nice thing about it is you can see the profit you could leave on the table if you are too aggressive. Let's say that you are the hodler, and it only goes up to a 0.8 risk level. So then you sell the 50% of your stack because you're selling the same percentage at each risk level. You make 196K. Okay, but if you had been the super aggressive route, you would have made 223K because you would have sold some at this level and some at this level, and the percentages would have been 33.3% at each level. So you would have made more, and if we only make it up to 0.8, then you would be better off doing this strategy than this strategy. So it applies to every you can think about that in terms of every risk strategy. So you can go in here and put in different values, whatever you think the projected price is. This is all anonymous, of course. I mean, it just shows me that you're an anonymous beaver or an anonymous buffalo or whatever it might be, an anonymous blobfish. I don't know who you guys are. But if you just want to play with it, you can just put in, you could say you're some whale and hold maybe 1,000 Bitcoin, and you can just see where it'll put you. So that'll wrap it up for the video. Welcome. We have a lot of new members. I hope you find yourself at home. Remember to send me a message on Telegram at BJ Cowan if you want to join the alerts channel, where I put my daily thoughts almost, I think every day so far, but I'm sure I'll miss a day at some point. So follow along there. We have around 250 people there, so there's still several hundred of you that need to join. So please message me, get on the list. Lots of excitement. Stay level-headed. Remember, as we said before, bull markets make you money, bear markets make you rich. Hopefully you capitalize on the bear market so that if the bull market is starting, you're going to become really rich. That'll wrap it up. See you next time. Bye.